898,000. That is the number. It is not a statistic. It is not a rounding error. It is a confession. The US government just quietly admitted that 898,000 jobs they spent the last year bragging about, jobs that supposedly proved the economy was booming, never existed. They were ghosts. For 12 months, the headlines screamed growth. The stock market rallied on the strength of the American consumer. The Federal Reserve kept interest rates high because the labor market was supposedly too hot. But it was all a mirage. When you strip away the noise and look at the raw data from the Bureau of Labor Statistics, the reality is terrifying. They revised the numbers down. They erased nearly 1 million paychecks with a pen stroke. To find a revision this catastrophic, you have to go back to exactly 1 year in history. You have to go back to 2009. Think about that. The last time the government accidentally overestimated the economy by this magnitude, the global financial system was actively melting down. We were in the depths of the great financial crisis. This is the 2009 signal. They are telling you, without telling you, that the system is broken. Headline numbers are designed to buy time. They are designed to keep you calm while the insiders exit the building. They pump the markets with fake optimism, and then, months later, when nobody is watching, they issue the correction. But you didn't need a government report to tell you this. You felt it. You saw the now hiring signs vanish. You saw the price of eggs and insurance skyrocket while your paycheck stayed flat. The data is finally catching up to your reality. This massive revision explains the other red flags flashing across the dashboard. Look at bankruptcies. In 2025, total bankruptcies spiked 11%. That is 574,000 businesses that closed their doors forever. That is the highest level since 2010. Look at delinquencies. Americans are defaulting on their debts at a rate of 4.8%. We haven't seen stress like that since 2017. The economy isn't growing, it is suffocating, and yet the yield on the 10-year Treasury is sitting flat at 4.18%. The bond market is confused. The stock market is in denial. But the smart money, the capital that actually moves the world, is not waiting for the next fake jobs report. They are running. When the paper economy lies, wealth flees to the only asset that cannot be printed, revised, or deleted. It runs to metal. But here is where the story gets strange. If you look at the price of silver on your phone right now, you are being lied to again. You might see a price of $82. You might think, okay, silver is high. You are wrong. That number on your screen is the paper price. It is a fictional value derived from trading digital contracts in New York and London. It represents a promise of silver, not the metal itself. To see the real price, the price that tells you the system is running out of inventory, you have to look east. You have to look at Shanghai. In China, the game is different. They don't want a digital receipt, they want the physical bar in their hand. And right now, the Shanghai Gold Exchange is screaming that there is no silver left. Traders in Shanghai are paying premiums of $22 to $40 over the spot price just to secure physical delivery. Think about the mechanics of that. In a normal market, if silver costs $82 in New York and $120 in Shanghai, a bank would simply buy it in New York, fly it to Shanghai, and pocket the difference. That is called arbitrage. It keeps prices equal globally, but that isn't happening. The gap is staying open. Why? Because the metal isn't in New York to ship. The vaults are empty. The Western banks are selling paper contracts backed by nothing, while the Eastern markets are draining the world of physical supply. This phenomenon has a name. It is called backwardation. In a healthy market, you pay more for something in the future because you have to pay for storage and insurance. Today's price should be lower than next year's price. Right now, we are seeing the opposite. People are paying significantly more to get the metal today than to wait for tomorrow. This is the ultimate distress signal. It means the market does not believe the inventory will exist in 6 months. It means get it now or never get it at all. The inventory data confirms the panic. Shanghai silver stocks have collapsed 88% from their 2021 peak. They are down to just 318 tons. That is vanishingly small for an industrial superpower, and the United States knows this. We are seeing a massive geopolitical shift that almost nobody is reporting. The US is actively intercepting silver concentrates from Latin America. Supply that used to flow freely to Asia to feed their factories is being rerouted north to plug the holes in the Western supply chain. This is not just inflation. This is a resource war. The West is desperate to keep the illusion of the paper price alive. If they lose control of the price, the bond market crashes and the currency collapses. So they suppress the paper price while physically starving the East. But you cannot print silver. You cannot revise a shortage of physical atoms. The disconnect between the fake economy, the one with the phantom jobs and the paper silver, and the real economy is about to snap. And the breaking point has a date. It centers on the COMEX, the primary exchange where these paper games are played. We need to look at the mechanism of failure, because the math for March 2026 is impossible. You have to understand how the COMEX actually works to see the trap. Think of it like a massive warehouse. In theory, for every paper contract sold, there should be a physical bar of silver sitting on a pallet waiting for the owner to come pick it up. That is the theory. The reality is a fractional reserve scam, exactly like your bank account. Since October 2025, that warehouse has been emptying at a terrifying speed. We have watched the inventory drain by 38%. We went from having 167 million ounces sitting in registered stockpiles down to just 103 million ounces today. Every single day, bars are leaving the vault and not coming back. Now look at the claims against that dwindling pile. This is where the math breaks. Right now, looking at the March 2026 contracts, the open interest, which is just a fancy term for the total number of bets placed, stands at roughly 340 million ounces. Divide. There are 340 million ounces owed to traders. There are only 103 million ounces available to give them. That is a 4x oversubscription. For every 1 bar of silver in the vault, 4 people are holding a valid contract claiming they own it. It is a game of musical chairs, and the music is about to stop. In a fair market, this would trigger an immediate price explosion. If 4 people want one house, the price of the house quadruples. Simple supply and demand. But the COMEX is not a fair market. It is a managed market, and the banks have a weapon they use to stop the price from exploding. It is called force majeure, or more commonly, the cash settlement. Here is the nightmare scenario for a trader. You buy silver because you are worried the dollar is collapsing. You hold the contract until March because you want the metal delivered to your door. But when you show up to collect, the bank says, "Sorry, we don't have the silver. Here is the cash equivalent instead." They force you to take the very paper currency you were trying to bet against. This allows them to default without technically defaulting. They don't have to find the metal, they just print the difference in dollars. This suppresses the price because no physical buying pressure ever hits the market. It's a closed loop of paper covering up paper. We are already seeing the warning signs that this is imminent. Look at the February delivery numbers. We are looking at 22 to 23 million ounces standing for delivery. That represents nearly 100% of the initial open interest for the month. Usually traders roll their contracts forward. They kick the can down the road. Not this time. Traders are standing their ground. They are demanding the metal. They are calling the bluff. This creates a massive squeeze on the suppliers, and this is where the geopolitical reality crashes into the financial fantasy. The banks cannot simply order more silver to refill the vaults. The global supply chain has fractured. In the past, if New York ran low, it would source metal from Mexico or Peru, the heavyweights of silver production. But the trade routes are changing. The United States government has quietly begun interfering in these flows. We are seeing reports of silver concentrates from Latin America, the raw stuff that gets refined into bars, being rerouted. It used to go to Asia to feed the tech manufacturing hubs. Now, it is being pulled north to the US. This is a desperate measure. You don't disrupt global trade flows unless you are terrified of running out. By hoarding the raw material, the US creates a bottleneck. It starves the Asian refineries. This is why the premiums in Shanghai are exploding to $40 over spot. The East is literally running out of input material because the West is hoarding it to mask a default. It creates a vicious cycle. The more the US hoards to save the COMEX, the higher the real price goes in Shanghai. The higher the price goes in Shanghai, the more traders in New York demand physical delivery to sell it in China for a profit. The gap widens until the mechanism snaps. And notice what else is happening in the background while the vaults drain. The behavior of the smart money has shifted. The CME group, which runs these exchanges, lists futures for something called NdPr, neodymium praseodymium. These are rare earth oxides essential for magnets, EVs, and defense tech. Why does this matter? Because institutional volume on these exotic metals is rising. The big players aren't just hedging gold and silver anymore. They are securing delivery of every critical physical asset they can find. They know what the jobs report revision signaled. They know the 11% spike in bankruptcies is real. They know the consumer is tapped out. They are preparing for a world where cash settlement is the norm, a world where having a contract is meaningless unless you have the item in your possession. This brings us to the immediate danger zone. We are entering a specific window of time where the manipulation creates the maximum amount of risk. The calendar is working against the banks. We are approaching a flashpoint, a specific set of dates where the liquidity dries up and the fraudulent paper claims are exposed to the light of day. It begins in mid-February. Mark your calendar, February 15th through the 23rd. This is the manipulation window. For these 9 days, China effectively goes dark. The Lunar New Year shuts down the Shanghai Gold Exchange. The massive physical buying pressure from the East, the pressure that has been forcing premiums to 40, temporarily vanishes. This leaves the Western banks unchecked. When the cat is away, the mice play. In this case, the mice are the bullion banks in London and New York. Historically, this is when they attack. Without the Shanghai arbitrage keeping them honest, they use low-volume trading hours to smash the paper price. They dump thousands of futures contracts into the market in milliseconds. Their goal is simple: panic. They want to drive the price down just enough to trigger your stop loss. They want to scare the weak hands into selling their contracts before the delivery date. If they can crush the price from $82 down to $72, they can cover their short positions cheaper and avoid the default. It is a desperate game of smash and grab. But this year, the math is different. This year, the strategy is suicide. Why? Because of what happens on February 24th. When China returns from the holiday, it won't panic at the lower price. They will thank us for the discount. If New York smashes the price while inventory is this critically low, the East will simply buy more. They will use the lower Western price to drain the remaining 103 million ounces even faster. The banks are trapped. If they lower the price, physical demand explodes. If they let the price rise, their short positions blow up. And that leads us directly to the single most dangerous day on the financial calendar, February 27th. This is first notice day for the March contracts. In the futures market, this is the moment of truth. It is the deadline where traders must decide: do I roll my contract to the next month, or do I stand for delivery? Usually 99% of traders roll. They are speculators. They don't want 5,000 ounces of silver dumped on their front lawn. But remember the backdrop. We just found out the economy is 900,000 jobs weaker than we thought. We know bankruptcies are at a 15-year high. We know the dollar has suffered a 10% debasement against real assets. The trust is gone. Big money managers are looking at that 10% currency loss and realize that holding cash is a guaranteed loss. They are looking at the 11% spike in business failures and realizing stocks are risky. So, for the first time in years, the incentive structure has flipped. Why would you roll your contract into the future if you don't trust the future? You wouldn't. You would take the asset now. We are seeing early indicators from the CME group that the roll rate is slowing down. Traders are holding on. If just 25% of the open interest stands for delivery on February 27th, the COMEX breaks. The math is binary. 25% of 340 million ounces is roughly 85 million ounces. The registered inventory is 103 million. That would leave the entire exchange with less than 20 million ounces of silver to back the entire global futures market. That is effectively zero. That is the moment the force majeure clauses get triggered. That is when the emails go out saying, "We cannot deliver metal, here is your cash." And that is when the price disconnect becomes permanent. The moment a major exchange admits it cannot deliver, the paper price becomes irrelevant. It could go to zero, it could go to 1,000,000. It doesn't matter because you can't buy anything with it. The real price, the street price for physical metal, will decouple completely. We are already seeing this with the 144% gain in silver performance over the last cycle. The market is trying to price in the default before it happens. But there is one final layer to this trap. It isn't just about silver. The rot in the jobs market and the drain in the silver vaults are symptoms of the same disease: stagflation. The economy is stagnating, low jobs, high defaults, while prices for real things are inflating, commodities surging. The Fed is cornered. If they cut rates to save the 900,000 missing jobs, inflation roars back and the dollar dies. If they keep rates high to save the dollar, the banking system collapses and the bankruptcies double. They have no moves left. The system is preparing for a reset. The insiders who are buying rare earths, gold, and silver are not betting on a trade. They are betting on the end of the current monetary arrangement. They are building a lifeboat. And you need to know exactly what that lifeboat looks like because it is made of 3 specific materials. It is a specific list of materials that the banking system cannot print, cannot revise, or cancel. But before you can grasp the solution, you have to understand the immediate consequence of the cash settlement trap. When the COMEX finally sends that email, when they force traders to take dollars instead of silver, it will not trigger a crash in the metal. It will trigger a bifurcation. That is a fancy word for a divorce. The price of silver on your screen will separate from the price of silver in your hand. We have seen this movie before. Look at the London Metal Exchange nickel crisis a few years ago. When the short sellers got squeezed, the exchange simply canceled the trades. They suspended reality to save the banks. The paper price froze, but the real price, the price manufacturers paid to actually get nickel, went vertical. This is the future of silver in 2026. You will see the official spot price trading at $82 or $90, managed and suppressed by the Western algorithms. But if you try to buy a physical coin, the dealer will laugh at that price. The street price will be $150, $200, or simply unavailable. This is why the 900,000 missing jobs matter so much right now. That massive downward revision was the final signal that the soft landing is a lie. The economy is not strong enough to handle this bifurcation. If the consumer were strong, maybe they could absorb higher prices, but the consumer is broken. Remember the 4.8% delinquency rate. That creates a ceiling on how much abuse the public can take. When the real price of commodities explodes because of the inventory shortage, the cost of living will soar. But wages will stay flat because those strong labor market numbers were fake all along. This is the stagflation trap. Prices go up, employment goes down, and the Federal Reserve is paralyzed. If they try to print money to stimulate the 900,000 lost jobs, they devalue the dollar even faster. This sends gold through the roof. We are already seeing the early stages of this. Gold has moved 66% in a single cycle, pushing toward $4,300 and eyeing $5,000. This is not a bubble. This is the currency collapsing against the metal. If they try to fight inflation by raising rates, they crush the 11% of businesses that are already bankrupt. They turn a recession into a depression. The system is checkmated, and the volatility is going to be violent. Do not expect a straight line up. The banks will not go down without a fight. As we move deeper into 2026, we will see whipsaw price action. We saw silver dip to $70 briefly before rebounding. Expect more of that. They will use every trick in the book to shake you out. They will slam the price down $10 in a single hour to hit your stop losses. They want you to panic. They want you to sell your physical position back to them so they can cover their shorts. Do not be the weak hand. The smart money, the insiders moving rare earth metals and draining the Shanghai vaults, does not care about the hourly price. They care about possession. They know that once the first notice day passes on February 27th, the game changes forever. The inventory is mathematically incapable of covering the claims. The 4.8x oversubscription at the COMEX is not a theory, it is a mathematical certainty. When the dust settles, there will be two types of people. There will be those holding paper contracts and cash settlements, claims on wealth that no longer exists. They will be holding the bag for a bankrupt system, and there will be those holding the assets that survived the reset. The 898,000 phantom jobs were the last line of defense. They were the narrative shield protecting the illusion. That shield is gone. The 38% drain in silver inventory was the buffer. That buffer is gone. The 11% spike in bankruptcies was the warning. The warning is now a reality. You are standing on the edge of the greatest wealth transfer in history. The paper system is burning down, and the fire exits are locked. You cannot rely on a job that might be revised away. You cannot rely on a bank account that yields less than inflation. You cannot rely on a stock market propped up by buybacks and debt. You need to exit the burning building, but you cannot just run blindly. You need to know exactly where to put your capital to ensure it survives the cash settlement event. 3 specific assets have no counterparty risk. 3 assets that act as a shield against default. I have broken down exactly what they are, how to acquire them, and why billionaires are accumulating them right now in this video. Click it. I'll see you there.